Most beginners, they don't lose money because the market is cruel. They lose money because they misunderstood what investing actually is. They think it's fast, they think it's exciting, and they think it rewards constant action. It doesn't. It doesn't. It rewards patience so quiet it feels uncomfortable. And that discomfort is where most mistakes begin. And let's talk about the investing mistakes beginners make, the real ones, the psychological ones. The first mistakes is confusing movement with progress. You log into your account, you see prices moving, you feel the urge to do something, buy, sell, adjust, react. You think activity equals control, and it rarely does. Constant movement is often just anxiety in disguise. You're trying to manage uncertainty by pressing buttons, but markets don't reward emotional reassurance. They reward discipline and activity. The more often you interfere, the more chances you give fear and excitement to sabotage you. And the second mistake is chasing what already happened. A stock is up 80%. Everyone is talking about it. It feels obvious, so you buy, not because you studied it, because you don't want to feel left out or left behind. This is not analysis. This is social pressure wearing a financial costume. You're not investing, you're reacting to attention. And by the time something feels safe because it's popular, most of the easy gains are already gone. You're entering at the moment of optimism is highest, and the risk is quietly rising. Number 3, beginners obsess over price instead of value. They say this stock is cheap, but cheap compared to what? A $10 stock can be wildly overpriced. A $300 stock can be undervalued. Price alone tells you nothing about quality or growth or durability. And this mistake happens because humans anchor to visible numbers. We assume lower price equals a better deal. But investing isn't shopping for discounts, it's purchasing future earnings and long term potentials. If you don't understand what you're buying, the number on the screen becomes a misleading comfort. And here's number 4, overestimating risk tolerances. In theory, you're aggressive. You can handle volatility. You're in it for the long term. Then the market drops 20%. Your portfolio, it bleeds red. And suddenly your long term mindset feels theoretical. You start refreshing constantly. You consider selling just to stop the emotional discomfort, not because the fundamentals have changed, because your nervous system did. And risk tolerance isn't what you say during good times, it's what you actually do during bad times. And most beginners, they discover their real tolerance only after, losses begin, which is the worst possible moment to learn. Number 5, investing without a clear time horizon. You put your money in, but you don't define when you'll need it. So every market swing, it feels urgent. If you might need the money next year, every dip feels threatening. If you won't need it for 10 years, dips are mostly noise. But without that clarity, your brain treats it as volatile, as bad, as danger. And time horizon is psychological armor. Without it, you interpret temporary fluctuations as permanent damage. The misinterpretation of this so leads to panic decisions that lock in losses unnecessarily. Mistaking diversification for randomness too. Beginners here don't put all your eggs in one basket, so they put a little of everything. Different sectors, different themes, different ideas, but there's no strategy, just scattered exposure. And the real diversification is intentional. It's balancing different risk profiles and collecting random assets. Otherwise, you end up owning many things you barely understand, which reduce risk. It multiplies the confusion, and confusion is dangerous because it makes you hesitant at the exact moments decisive calm is required. Ignoring fees because they feel small is another one. 1% here, okay? Half a percent there. It doesn't look dramatic, okay? But fees compound just like returns do, except in the opposite direction. Over decades, tiny percentages quietly eat large portions of your gains. And the tragedy is that you barely notice while it's happening. There's no dramatic loss. just a slow erosion that only becomes obvious in hindsight. And beginners focus intensively on picking winning investments, and they often ignore the structural costs that silently reduce every win. Number eight, believing you need constant new ideas. You need articles, watching videos, or scroll forums. You feel pressure to always, find the next opportunity. But most wealth and in investing comes from staying with good ideas long enough, not constantly, and replacing them with new ones. Switching to often resets compounding. You keep planting seeds and digging them up to check if they're growing. And that behavior, it feels productive, okay? But you're engaged. In reality, you're interrupting the very process that creates long-term returns. Even investors like Warren Buffett built fortunes largely by holding strong assets for long stretches, not by endlessly rotating them new picks. No. And here's another one, letting short term news override long term logic. A headline appears, and suddenly you doubt everything. You know, economic fears, political drama, market predictions. You feel informed, but you're actually being emotionally nudged. And news is designed to feel urgent. Investing success is built on ignoring most urgencies, and those two forces directly conflict. Beginners absorb constant updates and feel compelled to respond. But reacting to every piece of news turns investing into a reactive game instead of a strategic one. And a reactive players are easy for markets to shake out. There's another one. Measuring success too quickly. You invest for 6 months, maybe a year, and you check the results and you feel disappointed. No big gains, not life changing. So you start questioning the whole process. And this is the impatience is disguised as evaluation. Real investing is slow at first, almost just boring, which makes beginners think that they're doing something wrong. But the early stage is about building position, not celebrating outcomes. Compounding looks unimpressive, okay, until suddenly it doesn't. The problem is most people abandon the process right before that shift begins. And here's the deeper pattern behind all of these mistakes. They're not about intelligence, they're about emotional management, impatience, fear of missing out, discomfort from uncertainty, need for constant feedback. Markets constantly provoke these emotions, and beginners assume the solution is better predictions. It's usually better self control. You don't need to outsmart the market every week. You need to avoid outsmarting yourself at the worst of possible moments of panic, moments of euphoria, and moments of doubt. Because investing isn't a test of brilliance. It's more like a test of behavior over long stretches of time. And behavior is shaped by habits, not occasional insights. If you can avoid these beginners' mistakes, you don't suddenly become a genius investor. You become something more valuable, consistent, calm, a predictable in your discipline. And that predictability is what allows compounding to work without interruption. And uninterrupting compounding over years is what quietly turns ordinary investors into wealthy ones without dramatic stories or constant dramatic decisions. If you like today's video, make sure you check out this one to the right. Like, subscribe, comment down below. I love to hear from you. I try to get in touch with everybody. If you really like today's video, though, feel free to buy me a coffee. It's in the description and on the main page is the link. Thanks for watching, and we'll see you on the next one. Let's get rich together.